Something extraordinary just happened in the silver market, and if you're holding any precious metals, any retirement accounts, or frankly any dollar-denominated assets right now, you need to understand what this means. Because what we're witnessing isn't just another price move. It's a structural shift that's been building for years, and it just reached a critical inflection point. Let me show you exactly what changed, why it matters, and what the smart money is doing about it right now. 3 weeks ago, silver was trading in a range that had frustrated investors for months. The usual pattern: choppy action, false breakouts, the kind of price behavior that makes people lose interest and move on to the next shiny object. But then something shifted. And I'm not talking about a normal technical breakout. I'm talking about a fundamental change in the underlying market structure that most people completely missed. On November 11th, 2025, silver prices surged to 3-week highs. Now, you might be thinking, 3-week highs? That's not exactly earth-shattering. And you'd be right to be skeptical. We've seen plenty of short-term rallies that went nowhere. But here's what makes this different. This move wasn't driven by retail speculation or technical traders chasing momentum. It was driven by something far more significant. The Federal Reserve just signaled that interest rate cuts are coming. And the institutional money that's been sitting on the sidelines for 2 years just started moving. Let me explain why this matters. When interest rates are high, holding precious metals has an opportunity cost. You're not earning yield. You're not collecting dividends. You're just sitting on a chunk of metal hoping it goes up. So when rates are elevated, institutional investors tend to favor bonds and dividend-paying stocks. But the moment the Fed pivots and starts cutting rates, that entire calculus changes. Suddenly, the opportunity cost of holding gold and silver drops dramatically. And more importantly, rate cuts signal economic weakness, currency debasement, and exactly the kind of environment where precious metals historically thrive. Now, here's where it gets interesting. The Silver Institute just released their production forecast for the next 5 years, and the numbers are stunning. They're projecting global silver production will reach approximately 850 million ounces in 2026. That sounds like a lot, right? But then production is expected to fall back toward 800 million ounces by 2030. Think about that for a moment. We're looking at peak production next year, followed by a steady decline, at the exact same time that industrial demand is accelerating at an unprecedented rate. And when I say unprecedented, I mean it. Solar panel manufacturing alone is consuming silver at a rate that would have seemed impossible just 5 years ago. Every solar panel requires silver paste for the photovoltaic cells. There's no substitute that works as efficiently. And with governments around the world mandating renewable energy transitions, solar installations are projected to double over the next 3 years. Then you've got electric vehicles. Every EV uses significantly more silver than a traditional car. We're talking about silver in the battery management systems, in the charging infrastructure, in the power electronics. And EV production is ramping exponentially. So let me paint the picture clearly. Production is peaking and about to decline. Industrial demand is accelerating. And now, with rate cuts coming, investment demand is about to surge. This is the kind of supply-demand imbalance that creates generational opportunities in commodity markets. But there's another layer to this story that most analysts are completely overlooking. The COMEX silver market, where most of the world's silver futures are traded, is showing signs of serious stress. Registered silver inventories, the metal that's actually available for delivery, have been declining for months. We're now sitting at levels that are historically low relative to open interest. What does that mean in plain English? It means there are far more paper claims on silver than there is actual physical metal available to deliver. Now, you might remember what happened in 2021, when retail investors on Reddit tried to squeeze the silver market. Prices spiked briefly, then fell back. A lot of people lost money chasing that move. But here's the critical difference. That was a retail-driven squeeze based on speculation. What's happening now is an institutional recognition of a genuine supply shortage. Central banks aren't buying silver the way they're buying gold, but private institutions, family offices, and sovereign wealth funds are quietly accumulating physical metal at a pace we haven't seen in over a decade. Let me give you a specific example. In September 2025, one of the largest silver ETFs saw inflows of over 15 million ounces in a single month. That's the highest monthly inflow since 2020. But here's what's fascinating. This wasn't accompanied by a massive price spike. Why? Because the market is still dominated by paper trading on the COMEX. The futures market is so large relative to the physical market that it can suppress price discovery for extended periods. But that only works until it doesn't. And when the paper market finally breaks, when the disconnect between paper prices and physical availability becomes too extreme, that's when you see explosive moves. We've seen this pattern before. In 1980, silver went from $6 to $50 in a matter of months when the Hunt brothers tried to corner the market. Now, I'm not suggesting we're going to see that kind of move. That was a unique situation driven by market manipulation. But the underlying dynamic was the same. A recognition that there wasn't enough physical metal to satisfy demand. And when that recognition spreads, prices don't move in a straight line. They move in steps. Sharp rallies followed by consolidation, followed by another sharp rally. The 2011 silver bull market followed a similar pattern. Silver went from $17 in 2010 to $49 in 2011. But it didn't do it smoothly. It moved in waves. And each wave was triggered by a new group of investors recognizing the supply-demand imbalance. First, it was the gold bugs who already understood precious metals. Then, it was the inflation hedge crowd as QE ramped up. Then, it was the momentum traders who saw the chart breaking out. Each wave brought new buyers, and each consolidation shook out the weak hands before the next leg higher. Right now, we're in the early stages of what could be a similar pattern. The first wave of institutional buyers is moving in response to the Fed pivot. But the broader market hasn't caught on yet. Retail investors are still skeptical after years of choppy price action. The mainstream financial media is still focused on tech stocks and AI, but that's exactly when the best opportunities emerge, when the fundamentals are shifting but the crowd hasn't noticed yet. Now, let me address something important. If you're sitting on retirement savings, if you've got $100,000 or more in traditional IRAs or 401ks, you need to understand how precious metals fit into a retirement strategy. I put together a comprehensive guide on how gold IRAs work. It's completely free, and it's in the description below. It covers how you can get physical gold and silver into your retirement account without triggering tax penalties, how the custodian structure works, and what the costs actually look like. If you're thinking about diversifying out of paper assets, it's worth checking out. No pressure, just information. All right, back to what's happening in the silver market right now. Because there's another dimension to this story that ties everything together. The geopolitical dimension. We're watching the early stages of a global monetary reset. Now, I know that sounds dramatic, but look at what's actually happening. The BRICS nations, Brazil, Russia, India, China, South Africa, just expanded to include Saudi Arabia, UAE, Egypt, Ethiopia, and Iran. That's not a random collection of countries. That's a coalition representing over 40% of global GDP and a significant portion of global commodity production. And what are they doing? They're actively working to reduce dependence on the US dollar for international trade. They're settling oil transactions in yuan. They're exploring a BRICS currency backed by a basket of commodities. And while gold gets most of the attention in these discussions, silver is quietly playing a crucial role. Why? Because silver is more practical for smaller transactions. It's more affordable for average citizens, and it has industrial applications that make it strategically important beyond just monetary value. China understands this better than anyone. They've been accumulating silver for years, but they don't report it the way they report gold reserves. Why? Because they don't want to signal their intentions and drive up prices before they've accumulated enough. But if you look at import data, if you track flows from London to Shanghai, if you monitor what's happening in the physical market, the pattern is clear. China is building a strategic silver reserve, and they're doing it as quietly as possible. Russia is doing something similar. After Western sanctions cut them off from dollar-based financial systems, they've been stockpiling gold and silver as alternatives for international settlement. Iran, under sanctions for years, has been using precious metals to circumvent the dollar system. This isn't speculation. This is documented policy. And as more countries face the threat of sanctions or simply want to reduce dollar dependence, precious metals become increasingly important as neutral settlement assets. Now, here's where this gets really interesting for silver specifically. Gold is expensive. At current prices, a single ounce of gold costs over $2,000. That makes it impractical for everyday transactions or for average citizens to accumulate meaningful amounts. But silver, trading around $25 to $30 per ounce, is accessible. A middle-class family in India or China or Brazil can buy a few ounces of silver. They can't buy gold bars, but they can buy silver coins. And when you multiply that across billions of people in emerging markets who are losing faith in their local currencies, you're talking about a massive potential source of demand that doesn't even show up in the official statistics yet. Think about what happened in India during the 2013 rupee crisis. The government tried to restrict gold imports to protect the currency. What happened? Indians switched to silver. Silver imports surged. The same pattern played out in Turkey during their currency crisis. When people lose faith in paper money, They don't just buy gold. They buy whatever precious metal they can afford. And for most people, that's silver. So we've got industrial demand accelerating. We've got investment demand starting to pick up as rates come down. We've got geopolitical demand as countries diversify away from dollars. And we've got potential retail demand from emerging markets if currency instability spreads. All of this is converging at the exact moment that production is peaking and starting to decline. But let's talk about the supply side in more detail, because this is where the story gets even more compelling. Silver isn't primarily mined for silver. About 70% of silver production comes as a byproduct of mining other metals, mainly copper, lead, and zinc. What does that mean? It means silver supply is largely determined by the economics of those other metals, not by the silver price itself. If copper prices are low, copper mines shut down, and silver supply drops even if silver prices are high. This creates a unique dynamic where silver supply is relatively inelastic. It doesn't respond quickly to price signals the way a primary metal would. And right now, we're seeing stress in the base metal sector. Copper mines are facing declining ore grades. The easy deposits have been mined. New projects are increasingly expensive and face permitting challenges. Lead and zinc mines are dealing with similar issues. What this means is that even if silver prices rise significantly, we're not going to see a flood of new supply come online quickly. The supply response will be muted and delayed. Meanwhile, on the demand side, we're seeing something unprecedented. The energy transition isn't optional anymore. Governments have committed to net zero targets. They've passed legislation mandating renewable energy adoption. They've allocated trillions of dollars to green infrastructure. And all of that requires silver. Solar panels, wind turbines, electric vehicles, grid storage systems, they all use silver in critical applications where there's no economically viable substitute. The Silver Institute estimates that industrial demand for silver will increase by over 15% by 2030. But here's the thing. Those estimates are based on current policy commitments. If governments accelerate their green energy timelines, if EV adoption happens faster than projected, if energy storage becomes more widespread, that 15% could easily be 25% or 30%. And remember, this is happening while mine supply is expected to decline. Let me put this in perspective with some numbers. Global silver demand in 2024 was approximately 1.2 billion ounces. Mine supply was around 830 million ounces. The gap was filled by recycling and above-ground inventories. But those above-ground inventories are finite, and recycling, while important, can't scale fast enough to meet accelerating demand. So we're heading into a period where the market will be in deficit, and that deficit is likely to grow. Now, what does this mean for prices? Well, let's look at historical precedents. In the 1970s, when silver went from $2 to $50, it wasn't just about the Hunt brothers. It was about inflation, currency debasement, and a loss of confidence in the dollar after Nixon closed the gold window in 1971. The Hunt brothers just accelerated a move that was already underway based on fundamentals. In the 2000s bull market, silver went from $4 in 2001 to $49 in 2011. That was driven by quantitative easing, zero interest rates, and concerns about currency debasement after the 2008 financial crisis. But it was also driven by growing industrial demand from emerging markets, particularly China's infrastructure boom. Today we've got elements of both those periods. We've got currency concerns as central banks have printed unprecedented amounts of money over the past 15 years. We've got inflation that's proven stickier than policymakers expected. We've got geopolitical tensions that are driving countries to diversify away from dollars. And we've got industrial demand that's accelerating due to the energy transition. It's a perfect storm of factors that historically have driven silver prices significantly higher. But here's what's different this time. The market structure has changed. In the 1970s and even in the 2000s, most silver trading was in physical form or through futures contracts that were generally backed by physical metal. Today, we've got a massive paper market that dwarfs the physical market. The notional value of silver derivatives is many times larger than the value of all the physical silver that exists above ground. This creates the potential for a much more violent repricing when the paper market finally has to reconcile with physical reality. We're already seeing signs of stress. Premiums for physical silver over spot prices have been elevated for months. Delivery delays are becoming more common. Some dealers are limiting order sizes. These are all symptoms of a market where physical availability is tighter than the paper price suggests. And when that disconnect becomes too extreme, when enough people demand physical delivery instead of accepting cash settlement, that's when the paper market breaks. Now, I want to be clear. I'm not predicting that silver is going to $100 next month. Markets don't move in straight lines, and there will be volatility along the way. But what I am saying is that the fundamental setup right now is as compelling as it's been in over a decade. We've got supply constraints, accelerating demand, institutional accumulation, and a Fed pivot that's removing the main headwind that's kept precious metals suppressed for the past 2 years. And here's the thing about silver specifically. It's more volatile than gold. When precious metals bull markets get going, silver tends to outperform gold by a significant margin. In the 1970s, gold went up about 24 times, while silver went up about 38 times. In the 2000 bull market, gold went up about 6.5 times, while silver went up about 12 times. Silver is the leveraged play on precious metals. It amplifies the moves in both directions. So if you believe we're entering a period where precious metals are going to perform well, and the fundamentals certainly suggest we are, then silver offers more upside potential than gold. But it also comes with more volatility. You need to be prepared for sharp pullbacks along the way. This isn't a trade for weak hands. It's a position for people who understand the long-term fundamentals and can tolerate short-term volatility. Let me give you a framework for thinking about this. If you're building a precious metals position, most advisors suggest a core holding in gold for stability and wealth preservation. Gold is the anchor. It's been money for 5,000 years, and it's not going away. But silver is the growth component. It's the part of your precious metals allocation that has the potential to generate outsized returns if the thesis plays out. A common allocation might be 70% gold and 30% silver, or even 60-40, depending on your risk tolerance. The key is to think of them as complementary, not competing. Gold protects your wealth, silver grows it. And in an environment where both are likely to perform well, having exposure to both makes sense. Now, let's talk about timing, because that's what everyone wants to know. When should you be buying? Well, here's the reality. Trying to time the exact bottom in any market is nearly impossible. What you can do is identify when the risk-reward is favorable and when the fundamentals are aligned. And right now, both of those conditions are met. We just saw silver break out to 3-week highs on the Fed pivot news. That's the market telling you something. It's telling you that the institutional money is starting to move. Now, will there be a pullback? Probably. Markets rarely move straight up, but if you wait for the perfect entry, you'll likely miss the move entirely. The best time to buy is when the fundamentals are strong, but the crowd hasn't caught on yet. And that's exactly where we are right now. Think about it this way. In early 2020, right before the pandemic, silver was trading around $18. By August 2020, it had spiked to $29. If you waited for a pullback to $15, you never got it. The market just kept moving higher. The same thing happened in 2010. Silver was consolidating around $17, and people were waiting for a dip to $15. It never came. It went straight to $30, then $40, then $49. The point is, when a major trend shift is underway, the market doesn't give you perfect entries. It gives you a window of opportunity, and then it moves. And based on everything we're seeing right now, the supply-demand fundamentals, the Fed pivot, the geopolitical shifts, the institutional accumulation, we're in that window right now. So what should you do with this information? Well, that depends on your situation. If you're already holding precious metals, this is confirmation that you're positioned correctly for what's coming. If you're not holding any precious metals, this is a wake-up call to start building a position. And if you're on the fence, uncertain about whether this is the right time, consider this. The cost of being wrong by waiting is potentially much higher than the cost of being early. If you wait and silver runs to $40 or $50, you've missed a double or triple from current levels. If you buy now and it pulls back 10% before moving higher, you've got a temporary paper loss that will likely be recovered quickly if the thesis is correct. The asymmetry favors action over inaction when the fundamentals are this compelling. And remember, this isn't just about making money. It's about protecting what you've already built. If we're entering a period of currency instability, if the dollar's role as the global reserve currency is genuinely being challenged, if inflation remains persistent despite central bank efforts to control it, then holding some portion of your wealth in hard assets isn't speculation. It's prudence. It's insurance. It's the same reason you buy homeowners insurance even though you hope you never need it. The difference is, with precious metals, your insurance policy has the potential to appreciate significantly in value while it's protecting you. That's a pretty compelling proposition. You're not just preserving wealth. You're positioning for potential gains while simultaneously hedging against the risks that keep most investors up at night. So here's the bottom line. Something fundamental just changed in the silver market. The Fed pivot has removed the main headwind. Supply is peaking while demand accelerates. The paper market is showing signs of stress. Institutional money is moving in. And the geopolitical backdrop is creating additional demand that most analysts aren't even factoring in yet. This is the kind of setup that doesn't come around often. And when it does, the people who recognize it early and act decisively are the ones who benefit most. The silver market is sending a signal right now. The question is whether you're paying attention.